Hello and welcome to the Bulletin with UBS on Monocle Radio. Each week, the sharpest minds and freshest thinkers in finance take you beyond the numbers and hype, right to the heart of the big issues of the day. This week on the show, we're continuing to set the agenda for the coming 12 months. Back in November, as ever, UBS published its Year Ahead publication titled Escape Velocity? That question mark prompts an interesting course of thinking. Escape velocity in physics is the minimum speed an object needs to break free from the gravitational pull of a massive body without further propulsion. And at this moment in time, investors are asking the question, can a powerful combination of AI innovation, fiscal spending and easing monetary policy help the world economy break free from the gravitational pull of traditional end-of-cycle dynamics and accelerate into a new era of growth? To say that plenty's happened since November, though, would be something of an understatement, so we thought it was expedient to provide a quick update on what has changed since and how, if at all, the UBS house view has evolved. It's a delight to undertake that exercise in the company of our good friend and Bulletin regular, Kiran Ganesh. Now, it might be a little late to say Happy New Year, Kiran, but I'm going to say so anyway. Happy New Year to you. And I'll add a further caveat that we're chatting on January the 7th. Things are moving fast, so good just to note that. But yes, to start there, Kiran, 2026, it's kicked off at quite the pace, hasn't it? So much water under the bridge, I guess, since you and your colleagues published the Year Ahead back in November.
Yes, I mean, it feels like in some ways a lot has changed and in some ways not very much has changed. So maybe we start with the not much has changed. I think in terms of the broad outlook for markets and the economy, I think we still remain pretty well on track. I think some incoming data on the economy still shows that the US economy is still in pretty good shape. We've had decent data coming in from Europe as well. And in terms of the inflation picture, still a little bit higher than central banks would like, but they still seem to be on track to either keep rates on hold in the Eurozone and Switzerland and also cut rates in the UK and the US. So that all still seems to be pretty well on track since we wrote our outlook back in November. And what has obviously evolved is geopolitical risk. We've seen obviously the ongoing negotiations between Russia, Ukraine, the US and the EU about how we might come to some kind of peace agreement there. And of course, recently we've seen the capture of Venezuelan President Maduro by the US. And that has raised question marks, tensions between some of the major powers, and has also raised tensions between the US and the EU, with Greenland even now being discussed with the potential for the US to take it. So geopolitical risk has clearly increased. And I think we're seeing some of that in terms of what we're seeing in gold prices, which have been rising quite significantly. And I think for investors, that really does mean that, yes, this is still a good environment to be investing in, but it's also one in which investors need to be thinking about, how can we hedge portfolios? How can we make sure that we are insulated against some of that potential geopolitical risk?
Yeah, that's really interesting, Kiran. And just in terms of some of the things maybe that have developed a little bit in sort of weeks and short months since November, what about tech earnings? Because I think there's still clearly strong demand for chips to drive AI development. But in terms of that investor appetite or what investors are looking for, has that changed something? Have we sort of moved beyond, the stories about CapEx, and we're trying to look at businesses, enterprises, tech firms that really seem to show a bit of mastery of what their monetization plan's going to be?
Yeah, that has certainly been evolving. So we have seen the CapEx remaining strong and companies continuing to point towards higher CapEx. And we've started the year with still some pretty strong performance from some of the companies linked to semiconductors and the whole infrastructure value chain. So that trend remains very strong. But what we had started to see towards the end of last year, and we expect to continue 2026, is a bit more differentiation among investors, not looking for just CapEx, but also CapEx with some signs of monetization. And we did see something of a rotation, away from, just purely rewarding companies based on CapEx plans, towards looking at which companies are actually and gaining more users. We saw some strong performance from some of the big platforms who entered the last year where they've demonstrated strong user growth. Alphabet was a good example of that. So a bit more differentiation we are expecting to see in 2026. And we do think that generally the next big trade within AI is going to be more towards what we'd call the application layer. So the companies who are really using AI to develop products and services that are actually selling, and, a bit less focus perhaps on the enabling layer, which is been doing so well so far, though we do think that all parts of the AI value chain have still got room to grow, because this is really a mega trend that's likely to last a number of years.
Then in terms of other things which have kind of set fair, what about the view on fixed income and maybe the sort of slightly more negative outlook on the US dollar, which I know was in the year ahead piece from November? Are those some things which are kind of tracking as they were then, Kiran?
Yeah, I think they're quite interlinked, the fixed income question and the currency question. So, of course, we know that governments around the world are generally running relatively high fiscal deficits, and there doesn't seem to be the political appetite almost anywhere to try and meaningfully address those. So what we are seeing is more signs of governments putting pressure on central banks to be more accommodative. We've seen that in the US, we've seen it in Japan, and that will have an impact on currency markets, because if central banks are buying government debts and helping keep interest rates low that way, then something's got to give, and then often that's the currency. So we do think that interest rates are actually likely to come down across Europe and the US this year, and partly because we think that inflation will remain on a downward trajectory, and partly because you will have central banks in the US and the UK cutting interest rates, and we think that will start to push down bond yields. But with central banks potentially also playing a role in that and maybe shifting towards more intervention in bond markets, and we think that will also start to impact on currencies, and the relatively high level of the US fiscal deficit and some of the pressure that's being put on the Fed to cut interest rates is part of why we have a negative view on the US dollar relative to some of the other currencies.
Well, yeah, Kiran, let's talk a little bit about some other questions around allocation. And I know, again, if we look through the end of last year and the year ahead publication into the sort of the revisit in your latest publications, still a tactical allocation to commodities. There are a few options and interesting opportunities there. Tell us a bit about those.
Yeah, well, commodities is quite a diverse space. So you've got to divide it up into, if we look at the big parts, then base metals, oil, and precious metals. And I think if we look at the precious metals and the base metals in particular, then there is a pretty strong outlook, we think, for 2026. So on the precious metal side, we know the geopolitical risks out there. We know some of the concerns about government debt, some of the concerns about inflation. Gold is still a pretty good catch-all hedge for those kind of risks. And we know that big investors, central banks, are looking to diversify toward gold as they try to insulate themselves against some of those risks. So we think that flow will continue. And we're looking for gold prices to even hit 5,000 at some point during 2026. So we think there is a good upside on precious metals. And then on the base metal side, that's getting a couple of tailwinds. One has been well known for a while, which is the energy transition. And as we move away from fossil fuels and towards renewable energies, and that does increase demand for base metals. You think you're moving towards a electricity infrastructure, and that requires a lot of metals to facilitate that process. But they've also been getting an additional tailwind from things like AI, and that's been happening quite directly as part of the extra power investment that's been required to service those data centers, and that's been increasing demand for metals. But also the fact that power prices themselves have been going up has increased the cost of producing some metals, things like aluminium, and that is also raising their prices as well. So we think we've got these kind of dual tailwinds of the energy transition and AI, which are supporting the base metals complex as well. So we think with those two parts of the commodity complex doing well, then that should be sufficient to lead to broadly diversified commodities doing well on top. On the oil side, it is a bit more nuanced. Potentially we'll get some supply disruption now in Venezuela, which could be a short-term boost for oil prices. But of course, if longer-term production expectations start to go up, that could bring prices lower. So it's a bit more nuanced for oil itself, but we do think that the broad commodity complex is an interesting place to be. And again, if people are worried about geopolitics and especially in areas like the Middle East, then having a bit of exposure to oil in a portfolio can also help hedge against that risk.
Well, yeah, you mentioned gold as a hedge there and the D word, diversification, which we often discuss. What about the role of alternatives in this space, Kiran? And again, anything that's kind of nudging your thinking in a different direction if we compare where we were in November to where we are right now?
Yeah, I mean, I think the picture for alternatives remains quite similar to where we were in November. We do think that it should be playing a role as a diversifier in portfolios. And we do think that there are going to be good opportunities for equity long short, for example, in the next year, because we think we are going to get a bit more differentiation between, as I said, parts of the AI value chain, for example. And we do think that with some of these big macro trends taking place that we've talked about, that the macro strategies can also be doing well and helping diversify portfolios. I mean, generally, we think the outlook for both equities and bonds will be positive in 2026, but having something which is a bit less correlated to either of those in the portfolio, we think can help investors navigate any potential adverse shocks, which we are likely to face at some point in the year.
Now, Kiran, if we zoom out, look, we talked a little bit at the top about geopolitical instability or volatility or whatever you want to call it, unpredictability, I suppose. Just on that front, it's interesting. And it, again, in the sort of revisit piece that you and your colleagues published just last week, you talked about, continuing to navigate the year ahead with confidence, with intentionality, seizing opportunities to best meet clients' goals. Just if we zoom out a bit, just tell us or remind us really what that process of navigation looks like, particularly in volatile times. I know we often kind of come back to this refrain, but tell me why it's so important to remind and reassure, I guess, clients that, why you and your colleagues remain best positioned to do exactly that.
Yeah, so I mean, I think it's important to have a plan, right? I mean, I think you can face volatile times, and when they come, it's often quite easy to get wrapped up in the volatility and make decisions in the spur of the moment. But I think with the experience that we've had over many years working with clients through these crises, we find it very valuable to have a plan in advance and think about what are a client's long-term goals, what are they trying to achieve, and making sure that their investments are quite well aligned with what they're trying to achieve, because I think that gives a certain amount of clarity that when the volatility inevitably comes, you understand what is at risk and what is not at risk. And I think that can help improve decision making. So, having that plan in place is really important. And, I think when you develop that plan, investors can also, realize that there might be parts of their portfolio which they're holding too much of or holding too little of. So, it's common for investors to often be holding far too much cash relative to what they actually need. It gives a certain sense of security, but over the long term, can be a very significant drag on portfolios. We think that's one thing that investors should really be reviewing at the start of every year. How much cash do I really need and how much should I be investing? And then with the core part of the portfolio, what's the right mix of equities, bonds, and alternatives that can be a portfolio which can grow sufficiently over time, but also isn't taking too much risk and is something which the investor is comfortable with. So these are the kind of questions we think are important for investors to be reviewing at the start of the year. And, I think with many years of experience of working with clients, I think if they address those questions well, then they should be well positioned to deal with, whatever the year throws at us.
Kiran Ganesh bringing us to the end of this edition of The Bulletin with UBS, setting the agenda in the fast-moving world of finance every week here on Monocle Radio. You can listen again and explore more at the website monocle.com. That's where you can join the club and subscribe to Monocle magazine. And don't forget to discover more and find out how UBS can help you in 2026 by visiting ubs.com. This is The Bulletin with UBS on Monocle Radio. I'm Tom Edwards. Thanks for listening.